Hello friends, welcome back. I'm excited to share another very good option trading strategy that I use is the ratio spread and double ratio spreads. This strategy can be used in all kinds of markets, be it bullish, bearish or even sideways markets. When this strategy is designed properly, you can also control the MTM swings when the market fluctuates. This is Govind here. In this video, I am going to discuss about what is a ratio spread and what are the types of ratio spreads, when to use these ratio spreads using the examples and the payoff graphs. At the end, we will also look at the summary. I advise you to watch this video till the end to get an idea of the different ratio spreads and their usage. The ratio spread can be created by buying and selling of the same option types at different strike prices at different proportion of quantities. The ratio can be 1:2, 1:3 or 1:4. Just to give you an example, let us assume that Nifty is trading at 18,000 and you want to create a call ratio spread. So what I'll do is I will buy one lot of call option at 18,000 and sell two lots of call option at the strike price 18,100 CE. So this is nothing but the ratio spread which is created using the call options with a ratio of 1:2. So we have bought one call option at 18,000 strike price and sold two call option at 18,100 strike price. So this is how you create the ratio spread. Similarly, you can create a ratio spread for put option also. So when you create a ratio spread, there will be a net premium that will be received or that will be paid depending on which strike price and what kind of ratio you want to create. It is going to be a net credit or net debit ratio spread. There are three types of ratio spreads that you can create. When the ratio spread is created using the call options, it is called as the call ratio spread. When the ratio spread is created using the put options, it is called as the put ratio spread. When you create a ratio spread with both call ratio spread and put ratio spread, it becomes a double ratio spread. Here I have given the examples for each one of them. The call ratio spread example we just discussed, and the put ratio spread you can see here, bought a put option at 18,000 and sold two put options at 17,900. So this is 1:2 put ratio spread. In the double ratio spread example, both call ratio spread and put ratio spread are initiated together to make it as a double ratio spread. Now let us move on to examples and how the payoff graph looks like. Friends, let me use sensible option trading tool and Nifty as an instrument to demonstrate various ratio spreads. The ratio spreads can be created in weekly options or in monthly options. So here I am going to use a weekly option, that too a next week's weekly option in Nifty, because the premiums are better in next week's weekly option. So I'm going to choose 2nd February option chain and then create a call credit spread. So to create that, I'm buying one lot of 18,100 call option and selling two lots of 18,200 call option. So this is the 1:2 call ratio spread. You can see here the net premium received is 4,085 rupees for this ratio spread, and the break even on the upper side is 18,382. The call credit ratio spreads are created when the market is bearish. You take the credit and you are expecting the market to go down so that you can keep the credit that is received. Or even if the market goes up and expires below the break-even point, you will make the maximum profit. The maximum profit is 9,085 rupees when it expires exactly at 18,200. Friends, note that the ratio spreads are unlimited loss strategies. That is because there is always one open sold option in the case of credit ratio spreads. So this one open, so we have actually one buy and two sell. So one buy can protect one sold option, but the other open sold call option will be open. When the market keeps going up, your MTM swings are very high because the 18,200 call option will get into gamma effect, and in case if it expires above the break-even point, you will start making losses. So that is why these ratio spreads are unlimited loss strategies. We need to be careful in choosing the strikes and also the amount of credit that you want to take. So this is the call credit spread. Similarly, we can create put credit spread when the market is expected to go up. So I'm choosing the 17,900 put option for buy and 17,800 put option for selling two put options. So this is the put credit spread it has become, and the total premium that you receive is 2,200. This is the credit spread, and you can also see the break even point on the lower side for this one open put option, 17,656. And again, it is a unlimited loss strategy on the downside. Of course, you can increase the credit by increasing the ratio to 1:3. See here, the credit has increased to 6,200, but the break even gets reduced. And when you have this kind of more credit ratios, if the view goes against you, the MTM swings are very high and it will put you in trouble. I normally prefer to start with 1:2 credit spread, and when the market view goes as per my view, then I will increase the ratio to 1:2 or 4. So that is how you can handle. Now to create a double ratio spread, you just have to add a call credit spread that we have created just now to this put credit ratio spread. You see here, this has become a double ratio spread. So we have the put ratio spread. Sorry, I have 1:3. I'll bring it back to 1:2. Okay, so 1:2 put ratio spread and 1:2 call ratio spread. So this is the double ratio spread, and now you can see the payoff graph looking different. So it has break-even points on both the sides because you have both call ratio spread and put ratio spread, and you see the green area here. This is what helps us when the market fluctuates to control the MTMs. So when the market view is neutral or wide, one can take a double ratio spread based on your market view at different levels so that you can control the MTM swings. And again, I am emphasizing that these ratio spreads are unlimited loss strategies. Friends, let us now look at when to use which ratio spreads for different market views. We saw how to create the credit ratio spreads. Similarly, we can create debit ratio spreads. Whether to use credit ratio spread or debit ratio spread is all dependent on your trading style and the risk appetite for different market views. I trade with credit ratio spreads, and the preferred ratio that I use is 1:2 ratio, a maximum of 1:3. I never go beyond 1:4 ratio spreads. For bearish market view, I use the call credit ratio spread, and for bullish, I use the put credit ratio spread. For range bound, of course, the double credit ratio spread is what I use. The advantage of double ratio spread is that it protects from the market swings with the gamma effects and the MTM swings. All ratio spreads, whether it is a credit or a debit ratio spread, having one or more open option shorts are the risk unlimited strategies. We need to be ready to do the adjustment when the market view goes wrong. Here is a quick summary of the ratio spreads. Ratio spreads can be used in all kinds of markets. That is what we saw. And the ratio spreads with one or more open short options are the unlimited risk strategies which require a monitoring and adjustments. Do not simply use the higher credit ratios to get more credit, which may put you in trouble when the view goes wrong. Use double ratios to get more cushion against the market fluctuation and MTM swings. Whether to use credit or debit ratio spreads based on the market view is all up to your trading style and risk appetite. Avoid ratio spreads for the stocks with low liquidity because you may not be able to close some of the options or you may get into physical settlements. Friends, do let me know what kind of ratio spreads that you use in the comment section. I hope you learned something out of this video. If so, consider pressing the like button and also subscribing to this channel for the future contents like this. If you want to thank me for any of the content in this channel, you can now use the thanks icon below. Thank you for your time. See you soon.